Welcome back. You're still watching First Trades right here on ET Now. All's okay with the markets. Quick status check coming in on IT stocks ahead of Infi's earnings, which happen well, almost in the second half of trade this afternoon. We are, slowly and steadily nudging towards 10,500. For the broader market, seeing more traction. No, IT is not your, top sector on the index just yet. In fact, some bit of first trade correction is being seen in IT stocks. It's a sluggish start for IT. But tell you what, it's really oil marketing companies that were burning the screen yesterday aside of technology. And OMCs continue to be in focus. Stocks still have to recover market cap lost over the past few days. Investors remain cautious. How will Q4 pan out for the sector? Ajay Sharma, who watches the space so closely, joins in with a trend analysis. Ajay, take us through your findings.
Good morning, Tanveer. It's a very interesting point that oil marketing companies are not recovering from their losses, 15-20% lost in the last 1.5–2 months, despite clarification from oil minister as well as the management of most oil marketing companies. They are not really recovering a whole lot, though of course a very strong fourth quarter earnings lies ahead. Inventory gains will aid the margins. Petchem will actually be on the better side. But still, people are not ready to completely believe that the 1 rupee, the news that came in that 1 rupee will have to be absorbed on each liter of fuel by oil marketing companies. That's a nudge coming from the government side. Everybody has denied it, but we all know that in Gujarat election too, there was half a rupee absorption on marketing margins for at least 1.5 months on diesel and petrol, and that was also marked a massive phase of underperformance. So perhaps both may not talk about it very openly, but margins actually may remain subdued on the marketing side. That's what some people on the street believe, and probably that is the reason why all marketing companies are underperforming right now in the medium term.
Well, after yesterday's fall, at least they've stopped falling, but from the recent high, stocks are down more than 20%. So is crude the only reason why oil marketing stocks are coming down? Or in general, there seems to be a view and a belief that the best of the deregulation for oil marketing companies that's behind us. So let's take a conversation forward. Vikas Alan, Vice President Corporate Finance Group with Moody, joins us now. And Vikas, morning. Thank you for joining us. Vikas, first let's talk about crude. Is geopolitical factors the only factors why crude prices is back above $70? Because fundamentally speaking, the demand is still weak. We know that shale gas is real now, and historically, when I say historically, in 2015 and 16, every time crude prices have gone above $55–60 per barrel, the shale gas producers have quickly pumped in supply.
Yeah, primarily geopolitical risk. You've highlighted most of the factors, but one other factor that I would like to add is also weakness in US dollar. We have seen with the trade discussions between US and China, there has been some degree of weakness in the US dollar, which also tends to increase the crude oil prices, which is US dollar denominated. So both those factors, geopolitical is the primary. We, going back to pre-2014, when oil prices used to be 100, if you remember, geopolitical tension, particularly in Middle East, anything to do with Middle East would spike oil prices by anywhere between $10 to $15 per barrel. The current run is not very dissimilar. One other thing to note is the difference between WTI and Brent. Brent is at 70, 72, whereas WTI remains 66. So there's still that $6 gap, which has widened. Now that as you mentioned, the shale oil production is going up. It's now at its highest ever, and we think it's going to continue to grow with the current oil prices supporting that production level, and the production level will come in next 6 months. So combining that increase in supply with possible reduction in demand because of increasing prices, we can see a softer second half this year. Our house view continues to remain, though, that most of our ratings will have to withstand $45 to $65 oil price range. We haven't moved away from the lower band of the oil price, which used to be 40 and recently moved up to 45, but still we're maintaining 45 to 65. Over to you.
And so, Sumit, it's very important to understand whether back home in a rising oil price scenario, how OMCs will manage this price change. You know, yesterday I was talking to, we were talking to Sameer Arora, who's a noted investor based out of Singapore, and he was saying the litmus test of this deregulation policy lies in how the government and essentially the oil ministry as well as the oil marketing companies work together on ensuring that there is complete price freedom. So far, at least the sound bites that we are gathering, it appears to be the intent of both those involved organizations to not, you know, even roll back deregulation in a partial manner. If that's the case, then don't you think oil marketing companies should recover lost ground? They haven't quite done that. To my mind, that just shows the market is not convinced.
I agree with you on that. Market wants to see more how the things pan out in the near future. We believe that crude is expected to remain higher only. We do not rule out a possibility of crude touching to $80 to $90 Brent particularly in say next 2 years, which means there is more trouble coming for oil marketing companies, and we are in 2018 there are 5 state elections lined up, and 2019 May we have general elections. So this is a tough period to look for. How this thing is balanced out, we need to wait and watch. Definitely investors are not getting enough confidence to trust that these companies will not be asked to cap the pricing in price increase. So these are factors which makes investors cautious, and it's a wait and watch. So if I look at current earnings also for BPCL, we expect almost 2% decline in the Q4 FY 18, that is quarter on quarter, and we expect HPCL to report a 35% decline in earnings, and IOC we expect almost 40% sequential decline. This is mainly because of lower inventory gains in this quarter as compared to the last quarter, plus forex losses as compared to forex gain in the previous quarter. So these are the concerns which where the investors are not getting confidence that the earnings are not going to policies factor remains uncertain. So people are not touching oil marketing companies at this point in time. However, if I look at earnings of upstream companies, we expect ONGC to report a 27% growth, mainly supported by higher crude oil prices and higher dividend from IOC and HPCL. Similarly, Oil India is expected to report 20% jump in profit, supported mainly by higher dividend income from IOC. So these are the companies which one can look from a longer term point of view, from our view, because we are remain bullish on crude oil prices.
So let's just hang in there, and Vikas, wanted to get your view really on what's going on with OMCs. You know, considering we are grappling with this recent fear of controlling prices again, what's your take on the entire issue? Although there was a clarification coming out with the Indian Petroleum Minister just yesterday that, you know, he's not given out or sent out any directive to any of the OMCs to tamper with petrol or, for that matter, diesel prices. But this is getting to be a tricky space as an investment opportunity.
Yeah, look, our view on this whole deregulation was that it was positive, and we understood at the time that when the excise duty was increased to compensate for the price decline, that was to be the buffer, and that was to be the mechanism for the government to adjust the prices if it needed to. Now, I guess the new part of that equation is the GST, which has not been as high, or collection has not been as high as the government, which has reduced the government's wiggle room to reduce that excise duty. It could be, you know, the way to think about this is this could be the opportunity to kill two birds with one stone, where, you know, you are by removing excise duty and bringing in GST, or bringing the petroleum products into GST, this could be the opportunity for the government to look at this issue afresh. And we believe if you bring GST on the petroleum product, that could streamline both the processes. But for the OMCs particularly, first of all, 1 rupee per liter would mean $1.9 billion of loss for the entire year. given what the consumption has been for diesel and petrol. Now, if you put that into context, that's about 12,400 crores. For the April to December, the three OMCs have reported a total profit after tax of about 25,000 crores. So if this 1 rupee is extended for full year, you're talking close to 50% of their entire 9 months profit after tax. We don't expect this to last for full 1 year. This could be a maximum an impact of 1 quarter or maybe even a couple of months, before which the government takes a call on to reducing the excise duty. Also, let's not forget, oil prices are not given. Oil prices going up is not a given. It's going to remain volatile. This is partly driven by geopolitical risk, and when things cool down, the oil prices will also come down. And when the US production data comes out, I think the oil prices will also soften a bit.
Yeah, having that expectation, Sumit, how do you see this translating for the upstream companies? Yesterday, we had IOC talk about how they might be contemplating diversification and, sort of backward integration towards upstream. Give us your sense. Is that an indication that one is accepting that the way forward would be of higher oil prices leading to profitability if you were in that side of the business?
If we look at in the past also, in 1988 also, and after that, in the crude oil price, the movement does not happen just because of demand and supply factor. There are other factors too, which determine the price movement, and then the OPEC and cartelization factor is definitely affecting the prices. So we strongly believe that the momentum for crude to remain elevated, and we do not rule out a possibility of Brent crude moving to $80 to $90 per barrel. Definitely there will be a lot of volatility in between, and we are talking this target to be reached in next 2 years. In current scenario, obviously upstream companies are going to get benefited because of higher gas price, higher crude oil price realization. Plus, from 1st April, domestic gas price has increased, which is also positive for upstream companies. Considering these two factors and the government push to ramp up the volumes or crude oil production, we expect earnings to improve for upstream companies. Now, what needs to be seen is what the policy of government is. If there is any subsidy, again that regime comes, and then these companies may not do well. That remains an uncertainty. But at this point in time, we believe that upstream is expected to do better. However, if somebody wants to touch OMCs, then BPCL among the lot is better because they have a higher exposure towards oil business.
So, closing comments on which is the best stock, Sumit? I mean, let's understand which is the best OMC stock to buy. Is it HPCL, which is a pure play on India and diesel? Is it IOC, which is again a pure play on India with little bit of cross-holding structure here and there? Or will it be BPCL, which is a India play as well as lot of global assets?
Right. So as I mentioned that we are positive on crude oil price, and considering that into picture, we believe BPCL it looks better among three. Secondly, the company is also getting benefited because of its Kochi improvement in performance. So considering all these factors, and among OMCs, we believe HPCL will do better than other players, considering the government policy remains the same.
Okay, and so Vikas, let me let you have the final word on this discussion. Clearly, there is a lot of uncertainty in the oil market, as has always been the case. But do you think with Aramco aiming at $80 to a barrel, or signaling to the market that that's the price that they would like ahead of their IPO, with US-Russia tensions coming to the fore, and Russia's influence in the oil market also kind of, lifting sentiment on where prices would go from here, that this would be a defined, I know you put the range at between $65 to $70, but do you think that one could be surprised on the upside, or the oil market extending out on the upside 12 months?
Short periods of upside cannot be ruled out if particularly geopolitical tensions in Middle East escalate further. And consequent impact could be lasting as long as that tension lasts. But we believe fundamentally the oil market is not what it was pre-2015. So things have structurally changed. The production level that used to be dominated by OPEC is no longer the case. Plus, US shale production is now the largest component of the global production, or incremental production that you would see would come from US shale. Therefore, we think the control that OPEC used to have is no longer the case, especially if Russia actually falls under sanctions, which would actually take out a very big chunk of the oil supply. So we think the control that OPEC had in the past and control over the price is no longer as strong. So therefore, the price range that we have, 45 to 65, we continue to stick to that.
All right, Vikas as well as Sumit, glad you could join us to make sense of what's happening in the oil market and how that impact the Indian oil sector, the Indian oil and gas companies. Really appreciate your time.